Welcoming back one of our Boston Power players, Nik Tsoukales, Key Credit Repair. It's been a long time, bud.
It's been a while. Time's flying.
Now, you're a credit expert, been in the credit world for well over 10 years, right? Credit is a major part of the home buying process. Really, it comes down to credit, income, and assets. So with that being said, how does somebody prepare from the credit end when getting ready to buy a home?
You know, it's a really good question, and really we want to start with a few basic steps. So the first step is going to be to get to your loan officer and have them run a credit report. Even if you feel like the purchase is somewhat premature right now, you haven't found the house, you think it's something you're going to do 6 months from now, but you want to get to the lender to have them run a full FICO-based credit report.
Does that hurt their credit?
It doesn't hurt their credit, okay? Excessive, multiple, different types of inquiries hurt your credit. But if you are shopping for a mortgage or a car and you're keeping those inquiries somewhat similar within a fairly short period of time, it's not considered excessive. And pulling your credit, just pulling it once, there's no effect on credit. And that is verified by FICO on myfico.com's FAQ section.
That's a big misconception because a lot of people out there are always hesitant to have their credit pulled and they want a full-blown pre-approval. It's impossible. You have to pull your credit.
Well, here's the thing. Let's actually talk about that for a second. So where's that coming from? It's really a misconception. So a lot of the credit monitoring sites right now that you can jump on and get these free credit reports and these free credit scores that, by the way, banks and lenders do not use, okay? How do they make money? They're making money by reselling things to you. They're marketers. The more engaged you are with their app or their website by logging into their portal, the higher the probability that you're going to apply for a credit card on their site, or they're going to give you some sort of an upsell to get a paid credit membership on their site. So one of the ways they get you and kind of scare the bejesus out of you, saying you just had an inquiry, quick alarm, red alert, log into the app to find out how to deal with it, and you log in, you realize that credit score fell, the bank credit score didn't fall, and it's funny how, like, voila, they're offering you a credit card that they're getting paid a commission for. So you got to realize that's a major misconception. Yeah. It's garbage.
Okay. Now, in regards to cleaning up credit, somebody pulls their credit, they find something on it that they didn't expect or were not aware of. How do you go about that?
Well, we want to look at the quick points, okay, the fast points and the slow points that we can get. So we have a few examples we've worked on where a lender has pulled the credit report and it's coming at 580. And we know we really need 640-ish to really start getting some decent offers, and then somewhere in the 700s for those real top offers, right? So what we do is we first look at the deficit. Do we need 100 points to get them to their mortgage pre-approval? How do we make up those points? Can we make them up with quick points, fast points? And those fast points are typically coming from balance pay downs, paying down debt. That's the quickest way to increase your credit score.
Now, how do you know which debt to pay off first and how much?
It's a great question. So usually when you're looking at a lot of, personal finance blogs, they're going to tell you take all of your debt, put the smallest one on top of the list, the second smallest and second largest, and so on, and kind of work your way down the list and paying off debts. Where with credit scoring, it's similar to that, but slightly different, where we want to prioritize, number one, revolving debt. So we always want to prioritize paying off credit cards, okay? And really, which one we pay off first doesn't really matter. What we care about is the overall balance we have in proportion to the credit limit we have, or the total balances versus total credit limits. They call that utilization rate. So right away you want to prioritize taking your money and putting it towards paying down credit card debt to bring that utilization rate down. That's the biggest bang for your buck in terms of points.
And can have a significant impact. I mean, we've worked with you guys for years, and just reviewing over a quick conversation with the client, you've been able to get a client 30, 40, even up to 100 points.
Well, you know what? It's interesting you mentioned that. We can quickly get those points with a few tips. We have some clients that come to us that have had $30,000 in credit card debt and a $30,000 loan, car loan. And before they get to us, they decide, well, the interest rate is really high on the car loan. My credit card debt, the interest rates are like 2%. They're in some intro offer. So what do? They go ahead and take the $30,000 and pay off the car loan. And what happens? Their credit score drops because a car loan doesn't have a utilization rate. So when you have that money handy, always put it towards that revolving debt. Don't pay off your debt based on interest rate. That's what the personal finance guy will tell you to do. But the credit guy, the mortgage guy, is going to tell you get rid of the credit cards right away. It's fast.
That's awesome information. Very helpful. And if you have any credit questions at all, Nick and his team over at Key Credit Repair, keycreditrepair.com.
Absolutely.
And remember, we have more tips just like this one right here on boston.com.